A wordy question here on variances. Which of the following variances values would change if the company switched from standard marginal costing to absorption costing? Okay, so under these variances, at least one of them must be different, calculated differently under absorption versus marginal costing. And I'm given a bit more information up here. The company's operating costs are 60% variable and 40% fixed. So it's got some costs that are things that change in line with production when they make a different number of units, variable costs, things like direct materials. And they've got some fixed costs like rent that don't change when the business sells or produces more units. So this question relies on you knowing how to do the calculations for these various variances. You don't have to actually do the numbers, but you need to know them well enough to know if any are different under marginal and absorption costing. Let's go through them in turn. So the sales volume variance, first of all, that's when we've got a difference in the number of units that are sold between our actual units sold and our budgeted units sold. And under marginal costing, it gets multiplied by the standard contribution per unit. It goes right at the top of our variances reconciliation statement. And it's a slightly different calculation under absorption costing. Under absorption costing, it's still the difference in the number of units sold between actual and budget, but instead of being the times by standard contribution, as it was under marginal costing, it's times by standard profit per unit. Profit being the sales price less all of the costs, both fixed and variable. And if we look at this piece of information up here that we were told at the start of the scenario, the company has got some fixed and variable costs. That means that their contribution per unit would be different to the profit per unit because there are some fixed costs. So the answer is going to be sales volume variance. But I never like to just go for the first one if I think it's right. I like to make sure the other ones are wrong and I understand why they're wrong. The fixed overhead expenditure variance, that's my actual minus my budgeted fixed overheads. And that's going to be the same under both marginal and absorption costing. It's exactly the same calculation. My variable overhead expenditure variance next. And this is where I'm spending more or less money on variable overheads because of a change in the rate or the cost of variable overheads per hour. And I know my formula. My formula is I take the actual hours that the business has worked producing things, and I times that by the difference between the actual variable overhead rate per hour and the standard variable overhead rate per hour. And it is exactly the same calculation under absorption costing. There's no difference. And how about this last variance, the direct material efficiency variance? This is where each unit that I'm producing, I'm using more or less materials when I'm making that unit than I should have done, than my standard quantity for that number of units. And I calculate it by looking at the difference between the actual kilograms I used. And when I say kilograms, it could be litres or whatever materials it is that the business is working with. So the actual kilograms they used, minus how many kilograms they should have used to make the actual units of production. This is my flexed budget, isn't it? How many kilograms of material should they have used to make that level of production? And I multiply it by the standard price per kilogram. And again, it's exactly the same calculation under absorption costing. So I'm happy that the first one, the sales volume variance, is the only variance here that is calculated differently under marginal and absorption costing. And therefore, it is the first of these answers that's correct.